Welcome, Gowinvest family. This is lesson 3 of our series. My name is Sobi, and today we'll be talking about simple moving averages, exponential moving averages, MACD and RSI indicators. These are technical indicators, but I will guarantee you by the end of this lesson, you'll have some working knowledge that you can use to put in a good trade and buy something at a good value. So without further ado, we're going to cue the intro, and hope you like the lesson. Okay, so we are talking about lesson 3, SMA, EMA, MACD, and RSI. And I promise you by the end of the day today you'll figure out a way to trade some stocks that would probably help you in real life. So this is not just technical stuff, this is reality trading right here. And it'll help you in your day-to-day trading life. If you didn't already know this, I mean, there's a good chance a lot of people already know this. But assume that we had a stock here. This is the this is the price, and this is the time. Just like we had those candlesticks. In this case, we have a few candlesticks, and we basically just take the close out of each of the candlesticks. So whatever the close value was, we take that close value and we put it as a point. So I want to take this out. We do not have, we don't care about the rest of the candle when we're doing an SMA or anything. Basically, all calculations occur on the close values of the stock. Really trying to prevent this from occurring. Okay, so you just have your close vals, and you're gonna have points. So let's do this, 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 and this. All right, so say you connect them up into a line. Now you want to SMA being the simple moving average, you basically just say you have to give this moving average a window size. So that window size here in this case, let's say is 5, because there are 5 elements, 5 windows. So window size is 5. What you have to do, like say this is a 20, 21, 20, 21, and 22. You have to kind of add the all together, 20, 21, 20, 21, and 22, and divide them by 5. That'll give you some value like right on the middle over here. And then likewise, say that this drops after this to about 21 again. All right, and this was slightly above 21. Let me get an eraser. Because again, over half of them, or over half of the points, were above 21. And then you have another 21 occur over here. Now you're not taking the average of this point. You're taking out this point. You're only doing the average of these points. And because we lost this one and we got one that's one higher than that, then our overall value is going to jump. So the SMA value basically windows this. And then we have another point, and then it windows this. And then basically it moves on to kind of create another picture which is a sum of all the averages of the stock. So you'll have the stock move like this in a jagged way, and then you'll have an average run through it because of the simple moving average. Now, what is an exponential moving average? Let me delete all of this stuff. Okay, I hope you got whatever you need down. We're going to talk about the exponential moving average. I don't know why it doesn't work. All right, exponential. So you realize that if, say, you had a 200-point SMA, that you had the last point is weighted almost as much, last point change or whatever is weighted almost as much as the most recent change, which is pretty odd because you would think that, you know, this one has more weight in real time than the thing that happened 200 minutes ago. So what you want to do is you want to give everything a weight value. So like we had before, we had 0.1 plus 0.2 plus 0.3 plus basically point n, how many ever kind of continues this series onwards, and then divided by the number of all p's, just n, was a simple average. But in this case, what you want to do is you want to divide each point by a weight. And this weight could be, you know, in one case is like 100, so that this first one gets like a lot lower of a value. And over here, you can make it divide by 0.1, and that will make this 10 times stronger. So this is 100 times weaker. And this is just doing off-the-hand math. I mean, I don't want to go into too much detail with the math, but basically the last movement is weighted more with an EMA. And we can see this in actuality over here, where first I'm going to turn off extra stylings here. And let's bring in the EMA. So I'm going to click up here and we're going to bring in the EMA. You can see if I zoom in that the red line is the EMA and the blue line is the SMA. You can see that EMA tracks the stock a lot better than the blue line. And because the blue line is relatively unaffected by quick changes, whereas the red line is very affected by quick changes. So the red line tracks the stock more than the SMA, but we use SMA more as a marker of value because it's slower to change. So now let's forget about the EMA for a moment because it's a little more complicated on the math as well. And let's set up some more SMAs. So you can have one, here's one that is 5, here's one that's 10, here's one that's 20. You can see the 21 moves way slower than the one that's 10, which moves way slower than the one that's 5. So the 5 is called a short-term SMA. The red is basically called a midterm SMA, and the green is called a long-term SMA. So you have the short and the long. So let's consider something. If you look at a period of increasing value, and we gotta maybe move back for a while, we see here there's a period of increasing value. You see that the short-term one SMA overtakes the long-term SMA at that point. So it converges, then diverges, and that gives you positive value. Now let's see the opposite in effect. Over here, what you see is them kind of, I'm gonna zoom in a little bit. So we were above the SMA, a green SMA, and then now we started to trail, the blue line started trailing below the green SMA. And by trailing below the green SMA, it converged while it was above the green SMA, then diverged while it was going down. And what you get there is a downwards trend. So that could be a bearish indicator. Now that brings us to the next thing, which is moving average convergence divergence. MACD, it's the mother of all indicators by most traders. That's because you get a lot of information from this. Let me zoom out a bit so that you can see the full force of this MACD. You can see here that it always seems to ebb and flow. Down, up, down, up, down, up. And that is like breathing in and breathing out, and breathing in and breathing out. Generally, every follow of a breathe in will follow a breathe out, and it normalizes this graph. So whatever it's at, you really don't care about the price. You care more about the momentum. So what you're seeing, let's say here, you see a huge bunch of greens right there. And that's buying pressure. As soon as it goes up to the peak, it starts going red. This is selling pressure. So whenever you see this go up rapidly, you can say it's buying pressure. Whenever you see these reds come in rapidly, it's selling pressure on the MACD chart. Now, what else is there? Let me gonna zoom in. So the MACD itself is running a 12-point SMA and a 26-point SMA. The 26-point SMA being the longer term trend usually is the one that's slower. It's the blue line. Now the orange one is the 12-point SMA. It's the CCC, which is the control. So you minus the control to the signal and you get the histogram. The histogram is these greens or reds. If the histogram's above 0, it's going to be green. If it's below 0, it's going to be red. Generally tells you if it's buying or selling. The points at which you really want to take note of if it's well above the 0 mark. Both lines over here is well above 0 mark. You know, it's actually coming up to 0.5. And then it's falling. And so you want to put some sort of threshold here that you triggered that this was over 0.3, 0.4. Now it's coming up to 0.5 and you're seeing that the buying pressure is tailing off. This is a good place to put in a short. Now you can follow the downtrend. And you can really follow the downtrend until, and you'd probably want to sell at stagnation. But here you can see the downtrend goes, even though the stock goes up and then it goes down again, right here you'll be very on a very low side. You can probably anticipate that the next section would be a buying section after a triple down of MACD. Then you put in a buy order and then you ride the rise and then you sell. Very quick motions that you'll have to do. But again, these are almost 34 minutes out. So the difference between this and this is quite a few minutes long. And that's what happens with the lag indicator. So all of these are lagging indicators. You'll see the movement happen here on the real-time stocks well before it's indicated over here that this would have happened. So in fact, it's saying that the real peak happened here, but the real peak happened somewhere around here on the influx, on the changing of hands between the buyers and the sellers. Now, is that always the case that every sell follows a buy? And the answer to that is not necessarily, because it kind of depends on this volume indicator right here that you're seeing right underneath the graph. Like here you see a ton of volume, here you see a little less volume. But it also depends on, like, you can have triple up on MACDs, you can have triple down on MACDs, and generally a single down will follow a single up. But if you go down again, there's a chance that it can go down again. And if it goes down again, the probability of it coming up is even higher. Then it goes down again, the probability of it coming up from there is even higher. So what you can do is kind of Fibonacci into this. So you put down, maybe you break your money up into 4 units. You put 1 unit here. It went down again on this. So then you put in another unit there. And then it went down again. You put in 2 units there. Then when it comes back up, you're basically netting 2 units because these 2 units might be lower and you dollar costed average into a gain. So that's how you can kind of play a MACD, but basically you use this to kind of gauge buyer pressure and seller pressure. I'll show you some better indicators later on. Let's talk right now about the relative strength indicator. So I'm going to go here to a new page and talk about the relative strength. STRENGTH indicator, are the RSI. So with the RSI, what you do is, say you have a whole bunch of movement, and what you do is you section it out. You're doing a 14-point SMA. It's a EMA actually, but this is not a traditional EMA. What you do is you cut it in half, and you see how many movements from those 14 points were positive movements and how many of them were negative movements. So we have one positive movement here, a negative movement here, negative movement here, negative movement here, positive movement here, positive movement here, positive movement here, positive movement here, negative, 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 negative. And what you do is you basically do EMAs of both. So you have EMA of ups, and then you have an EMA of downs. And this will give you some sort of fraction. So it can never really be anywhere less than 0, generally. So see here, you can see up here, there's a bigger calculation if you really wanted to do it, but I'm just going to go through the simple ones. So basically you take the averages of the ups and averages of the downs, and it is weighted average because it's weighted by how many points you're getting. So it's generally done with an EMA, and so the lowest value it could be 0. The highest value it can be is maybe 10,000 or something like that, something crazy, depending on how many EMA points you're taking. But generally, we're at a 14 point. So what you do is then you normalize it from 0 to 100. And how you do that is by doing 100 minus 100 over 1 plus the E up over E down. And that is your RSI. What this does is, like, say if this was 0, then 1 plus 0 is 1, 100 over 1 is 100, RSI is equal to 0. Say this is infinity or any big number, this term goes down to 0, so this is the full 100. So that's how you've normalized it from 0 to 100. Let me show you how trading that makes some sense. Over here, we're looking at the RSI. Generally below, you see these 2 lines here at 30 and 70. If it's below 30, and it falls well below 30, that means it's oversold. Too many people are selling it. Time to buy it. All right. And then once it goes over 100, say over here, it went over or over 70 more so. If it goes over 70, it's overbought and it's time to come down. So really, you look at this is overbought. Too many people are buying. Needs to come down. Over down here, it's sold. Too many people are selling. Needs to come up, and generally play within that range. This is again not 100%. And I wouldn't use the RSI indicator as the only sales point because it can still not tell you downward trends. Let's say you bought here, thinking that it's a low of the RSI, low of the MACD, can kind of indicate somewhat of a rise, and it does for a little bit. But then you have this huge, massive downturn that is not reflected well in these indicators because these indicators have to stabilize. Um, So that's the big problem there, is that you cannot solely rely on these two indicators. There's another indicator that I'll be talking about in the next class that is 100% ideal to running these type of plays, and you can use that indicator all by itself. You don't need to use it in conjunction with other indicators. But in this case, you can see here the volume is something that you need to take into consideration. The the directionality of that volume, you can see here that this volume here spike is red. That means huge selling pressure. In fact, every time that it comes in, it seems to be huge on the selling side, and and the buyers are just trying to keep it up. There are definitely some buy signals in there, but not as much as the sell signals, and you can tell that this is going to go down, maybe not touch this. But generally, when something is really down, like this has gone down to almost negative 40, it's time for somewhat of a reversal. Now, how big is that reversal? You just wait until stagnation basically comes back up to near zero, and at that point sell out because it's not worth continuing on this fight. You really don't know where anything will go. That's the whole idea with trading, is you're never 100% sure of anything. But what you can do is you can play the change of flux, change of hands from selling pressure to buying pressure, or from buying pressure to selling pressure. Now, again, most people cannot go negative on the stock unless you're basically shorting the stock or selling or doing a put option on the stock. I wouldn't suggest that. My best explanation for this is when you're looking to buy something and a company has proper fundamentals, you would want to go in, wait through the day. Don't trade on morning highs. Right at 9 o'clock, crazy stuff starts to happen, and you can't deal with things that are crazy. So what you want to do is wait for it to level off during the day, wait for a nice dip below on MACD and RSI, and then at that point make a good judgment call to get in. And maybe if you want a consistent gain, wait till the first turn of MACD and sell on first turn of MACD, and rinse and repeat. Day after day, you're going to get, I'm guaranteeing you'll make money. But you have to follow that precisely. Never trade on a Friday. Fridays are just wacky days. They're the last day of the market. It fluctuates like crazy. There's a big inflow and big outflow. Everyone's trying to be cash by the weekend. So my suggestion wouldn't be to do this on that, but say you were on a Monday, you were looking to get in on the stock, you waited for the FOMO buying in and the crash and everything to occur and basically the market to stabilize. Wait for something like this to dip, capture in on it, wait for first turn of MACD, sell out. I don't care if it's multiple, it'll go up from there, but sell out and just look for the next move. On whatever stock it be, look for the next move. Do this consistently day after day. I will guarantee you will make money. But that's for now, and then maybe next time we're going to talk about Bollinger Bands and how this is the one indicator you can use to guarantee yourself to make money. However, you need to know the idea of probabilities. Okay.